Hi guys, it's Doc Curry, and I've got breaking news coming from Treasury Secretary Janet Yellen. The United States is about to default for the very first time in U.S. history. I'm going to explain what's going on, so let's get into it. Late Monday afternoon, we got breaking news that the Congressional Budget Office had done an updated estimate on how long it would be before the United States ran out of money. And let's just say the estimates are way sooner than anybody in Congress had predicted. Treasury Chief Janet Yellen says the U.S. risks default as soon as June 1 without a debt ceiling increase. This new forecast gives Republicans and Democrats just weeks to reach a deal. The June 1 deadline is much sooner than expected. Because tax receipts through April have been less than the Congressional Budget Office anticipated in February, they now estimate that there is a significantly greater risk that the Treasury will run out of funds in early June. And of course, these decreased taxes aren't just affecting the U.S. government, they're also affecting state governments as well as local municipalities. The problem is that a lot of governments were expecting high taxes to come in based upon what happened in 2020, 2021, 2022, when the government was just printing a ton of money and people were making a lot of money. But now there's been a lot of layoffs, a lot of people are out of work, wages have come down, inflation is up, and as a result, the amount of taxes the governments are collecting is significantly less than it was in the past, meaning we no longer have all these surpluses where some of the states are able to give money back to their residents. In addition, the U.S. government that thought we had a certain deficit, turns out that deficit is actually a lot larger than expected because the amount of taxes being collected are a lot lower than expected. And as a result of all of this, it's causing problems to occur much faster than we had originally expected. Congressional calendars showed Monday that there were only 8 legislative days this month when both the House and Senate will be in session at the same time. And this could significantly impact any effort to hammer out a last-minute deal in person on a debt ceiling hike. The problem is the U.S. government can only borrow a certain amount of money in order to pay its obligations. And once the government has hit its limit, kind of like when you max out a credit card, you just can't spend any more. And that's exactly what's happening here in the United States. We're essentially going to max out our credit card or hit our debt limit in about 4 weeks. And when we do, we're no longer going to be able to pay our bills. Now, a couple of things that I want to clarify here. First is the U.S. has never in history defaulted on its debts. However, just because it's never happened in the past does not mean that it will never happen. It just hasn't happened yet. And given that the U.S. is going to run out of money much faster than we had previously expected, and given how much Republicans and Democrats are refusing to work together on this issue, the risk of default is much higher today than it has been at any time in the past. And unfortunately, whenever we get close to a default, this usually causes a pretty significant downturn in the stock market. A prior Goldman Sachs estimate had noted that so far there have been few ripples in the market from the rising debt-related risk. But the estimate said that this could change. And it would change once the Treasury announced a specific deadline for Congress to raise the debt limit. Well, guess what? That deadline has been announced. And that deadline is June 1, which means the ripples in the stock market and the ripples in the economy could now play into effect. So just how much could the stock market fall? Well, a quick look at history going back to September of 2021, the last time that we were about to hit the debt limit, the stock market fell 5% in a single month. However, it then very quickly recovered. So we can expect a pretty significant drop in the stock market. However, whatever drop in the stock market we do get here in the month of May is probably going to be short-lived, and the stock market will probably recover very quickly once the debt ceiling is increased. However, there are some situations that could cause the stock market to fall far more than 5%. It doesn't necessarily require the US to default in order for the stock market to fall more than 5%. Back in August of 2011, the stock market fell 20% in 1 month when the US was very close to hitting its debt limit ceiling, but another major event coincided with it. In August of 2011, while Congress did raise the debt limits, the problem was the U.S. credit rating got downgraded. And when the U.S. credit rating got downgraded, the stock market sold off 20% in a single month. So you see, it doesn't necessarily take the U.S. to default in order to cause a major crash in the stock market. All we have to do is get very close to default, have a credit agency downgrade the U.S. credit rating, and that alone could cause the stock market to fall 20% in a single month. So it's not really a matter of if the stock market is going to sell off in May. It's a matter of how much. Will it be 5%? Like it normally is in the past, with a very quick recovery, or will it be 20% or more due to the fact that the U.S. credit rating gets downgraded? And I don't even want to imagine how much the stock market might fall if the U.S. actually defaults. And by the way, given how much Republicans and Democrats are so close to not coming up with a deal and they're just fighting and bickering, the risk of a default today is greater than it ever has been in the past. Now, usually what happens is once we do get to that point of default, we will shut down the U.S. government, meaning we'll stop paying government employees temporarily. They will get back pay. And that will usually give the Congress and Senate an additional weekend to work out a deal. Usually the government will shut down on a Friday, and then over the weekend, they'll work out a deal. Sometimes the government will be shut down longer, up to a week or two, or sometimes even 3 weeks. But generally, a deal is worked out over a weekend. Still, the longer this drags on and the closer we get to that June 1 deadline, the more and more you can expect the stock market to fall. So even if Apple earnings are great, even if the Fed comes out and they're dovish on Wednesday, we could still see a pretty significant stock market sell-off due to the fact that the United States is out of money. And in a follow-up to the news that I gave you yesterday, First Republic Bank has been seized and it has been sold to JP Morgan Chase in what is now the second largest U.S. bank failure in U.S. history. First Republic's failure is larger than Silicon Valley Bank and larger than Signature Bank. It follows only behind Washington Mutual in 2008. JP Morgan said it will assume all of First Republic's $92 billion in deposits, both insured and uninsured. It is also buying most of the bank's assets, but not all, including about $173 billion in loans and about $30 billion in securities. As part of the agreement, the Federal Deposit Insurance Corp, or FDIC, will share losses with JP Morgan on First Republic's loans. The agency estimates that its insurance fund would take a hit of about $13 billion in the deal. As I reported yesterday, had a deal not been reached, it would have cost the FDIC about $20 billion. So this deal with JP Morgan saves the FDIC about $7 billion. Still, the $13 billion loss will be shared amongst all of the big banks, as the funds from the FDIC insurance fund are going to have to be replenished, and those get replenished through big banks paying into the FDIC insurance fund. The good news in all of this is that First Republic's failure seems unlikely to spur another crisis of confidence. This is widely seen as the last stages of that initial panic from 2 months ago. First Republic's problems started as a result of the Silicon Valley Bank and Signature Bank failures. And Jamie Dimon, CEO of JP Morgan Chase, reiterated that, saying this part of the crisis is over. Now, just because this part of the crisis is over does not mean the banks are completely out of the clear. As we've talked about many times on this channel, the next crisis is going to be the commercial lending sector. Commercial real estate has dropped significantly in value. In some cases, commercial real estate properties are worth only 20% of what they were worth a few years ago. And some $80 billion in commercial real estate loans have to get refinanced this year. The biggest risk is that commercial property lenders are going to stop paying on their loans. And as a result, banks are going to end up taking on these properties at significantly lower valuations than what they were worth when the loans were originally set into place. As a result, banks could be facing significant losses on their commercial real estate loans here in the next few months. And this would be very similar to what happened in 2008. Only instead of happening in residential real estate, it would now be happening in commercial real estate. The effect for the banks, however, would be the same. Many more bank failures are expected later this year, and it's one of the reasons why the Federal Reserve still expects a recession by the end of the year due to more banks collapsing due to these commercial real estate loans going bad. And speaking of the Federal Reserve, we have to remember that the Fed is meeting for their monthly FOMC meeting on Tuesday and Wednesday. The interest rate is widely expected to be raised again on Wednesday. And as a result, the 10-year Treasury yield has ticked higher ahead of the Fed meeting. Higher Treasury yields are historically bad for the stock market, as investors tend to pull money out of the stock market and put it into bonds, as they get a more attractive rate on the safer bond assets than they could get in the more volatile and risky stock markets. Now, if you want to make money during this expected downturn in the markets in May, and you want to make money as the market goes down, I encourage you to come join my options coaching program, where I will teach you how to trade options so that you can make money no matter what the market does, whether it goes up, down, or even trade sideways. If you're interested in that, schedule a call with my onboarding specialist to get more information on the program. You can schedule a call with my onboarding specialist at weprofitdayandnight.com. That's weprofitdayandnight.com. If you got a lot out of this video, then be a good friend and share this video on your social media pages so that others will know what's going on in the market as well. And don't forget to hit the like button and subscribe. And if you missed yesterday's video where I went over the banking crisis in more detail, make sure you watch the last video that I uploaded here.